Hello and welcome to tradingfloor.com's weekly equity update. As the world absorbs the details of the second dose of quantitative easing, the much argued debate of QE being the right or wrong prescription can now be explored in greater depth. And now there's talk of a second round not being the final round, as QE3 looks to be the next round of discussions taking the spotlight. And with us we have Blaabjerg, Chief Equity Strategist at Saxo Bank. Christian, welcome again.
Thank you.
And it's been quite a big week and a much anticipated week for a long time as we've all been talking about quantitative easing now for, it seems like, forever. We can now really have a look inside of what quantitative QE2 is. And I just wanted to quickly ask if we compared QE1 to QE2, what are the things that we can see the points of difference?
In terms of differences, obviously the QE1 was targeting banking and making sure that the major banks' balance sheets were bolstered with enough liquidity and capital in order to sort of reject any storm that might be further down the road. QE2 has a different purpose. Its basic purpose is to create growth and jobs, and it will. Unfortunately, just not in the United States, but most likely in emerging markets. So our main argument is that QE2 is going to disappoint policymakers in Washington because the jobs and the growth will be directed into emerging markets. And on back of this, we believe that a QE3 will be launched at a point in time.
So, you know, if we have a look at, QE2, if we compare them, could we say that QE2 is really kind of that shotgun approach at trying to solve a serious problem?
The problem with quantitative easing is, from a policymaker standpoint, is that you never actually know where the market where the money is flowing to. I mean, it's the usual stuff. They are going into the banking system, and given the very low rates, the anticipation, at least from the Fed policymakers, is that this will be transferred into companies who, through capex, that is investments, will create jobs, or the very wanted jobs, and growth. The only issue in this regard is, or not the lacking assumption in the analysis, is that if you look at the cost of equity, it is very, very high. So actually, seen from a rational point of view, from a company CEO, it does simply not pay off to build rather than to buy. Actually, it's much cheaper to buy old capacity through M&As or outright buying back shares in order to behave rational as a single agent. And this leads to sort of my point that what we're going to see is not job creation within the US or Europe for that matter, but other emerging markets. And the reasoning for emerging markets where the job creation is going to happen, according to our view, is that currently the demand curve in Europe and the US, the change in the demand curve is virtually flat, in the sense that it's not moving, and it's not going to move for many years to come, simply on the back of that, both on the government side and the private household side, there's massive deleveraging going on. But contrary to that, in emerging markets, you don't have this issue because there's not that much debt on the government side and in household sides. In most instances, there are actual savings. So a lot of investment is going to take place there, and a lot of demand will arise, and there's potential for strong demand. And obviously, if you're a company CEO and finding it too expensive due to the cost of equity to build in your home country, you'll start investing in these countries where there's a payoff. So consequently, we actually think that the situation is going to end up that this was merely a boost or an injection of cheap liquidity right into emerging markets.
So could we say that it could potentially be fueling this decoupling that we will be seeing over the next
I don't think we're going to see decoupling, because you need to remember who is injecting cash into what. Namely, the cash is coming from the developed world and into the emerging markets. And since the sort of causality in terms of where the cash is coming from, cash can also be withdrawn. But the point is simply that we think that Fed policymakers is making an erroneous assumption in thinking that there's going to be built in their home country instead of built abroad, where the return on investment is simply bigger.
And we've discussed earlier with Andrew Robinson about how they'll be doling out the QE measures to keep it fairly flexible. Could you go through some scenarios of how they could be
Sure.
spelling it out?
Currently there's sort of only an indication as to how they're going to channel this out, namely buying back bonds in the long end of the curve. What I expect is that they'll stick to this strategy, as the Fed policymakers, at least if you look at their last speeches through the last 6 months, they're sort of into this recursive idea, namely that they inject a little, see how data reacts, and then inject a little more, reacting on data instead of what they anticipate. The reasoning why we believe there might be a QE3 is actually in order to create a job creation process that's positive in the United States, you need simply to have the cost of equity going down. And there are sort of various scenarios, from the most extreme where Fed is just starting to buy outright equities, buying the equity market. Then the cost of equity will obviously go down, P is up, and CEOs will be incentivized to build rather than to buy. There's also other scenarios where you can sort of tweak this reaction from CEOs, but the main message from our standpoint of view is that the QE2 will fail in its job creation process in the United States because the investment returns are far bigger in emerging markets, given the cost of equity. And if you want to have the job creation process succeed in the United States, you need to lower the cost of equity.
So just to finish up on, if we are looking at this QE3 following probably what would be a failed QE2, what would it look like, and when could it possibly roll out?
In terms of timing as a rollout for QE3, I virtually have no clue. But in terms of how it's designed, I have a few clues. First of all, you'll not see the usual sort of trick played, namely buying back bonds in the longer end of the curve in order to put the curve flat down, because it is already flat. What you'll see is, I would expect, some buying up in equity markets, either directly or indirectly, or you could see other measures in that regard which will virtually have that effect, namely lowering the cost of equity. But going forward, I think there's a great likelihood that we're going to see a QE3 on the back of a failed QE2.
Okay, Christian, thanks for those insights. And don't forget, you can keep up to date with global markets on tradingfloor.com, and you can also follow us on Twitter at tradingfloor.com. Thank you, and we'll see you next time.